Vanguard's 19, not 2009, forecast part 3. And if you're still with me, you are you're a good person, my friend, because I can see this boring a lot of people. For some ungodly reason, this does not bore me in the least, and I like sharing it. I like talking about it, and hopefully there's still someone out there in the YouTube land that's listening. So let's dive right into it. Don't forget to subscribe. So we're going to go to part 3 again. A modest yet persistent challenge that the global economy will face in 2019 and beyond is the growth in global debt. And can't even talk now. I'm yapping so long. In part because of ultra-stimulative global monetary policy. Global debt levels have rarely, if ever, been higher and may be sowing the seeds for the next crisis. That does kind of frighten me some. The global debt to GDP ratio stood at 220% in 2018, up from 175% in 2008. Specifically, 2 segments of the global debt markets are concerning: emerging market debt denominated in hard currency and non-financial corporate debt in the U.S. and Europe. I thought that's interesting. Non-financial corporate debt in the U.S. and Europe. I was under the impression that corporations in the U.S. Were getting rid of their debt and having just huge amounts, voluminous amounts of cash on hand. But we'll see what they say. In the case of the latter, that would be the non-financial debt in the U.S. and Europe, rapid growth in so-called leveraged loans is particularly alarming, having accounted for about 50% of the total corporate debt issuance in 2008. Whoa, I was not aware of that at all. And the rapid growth in so-called leveraged loans has accounted for 50% of the total corporate debt issuance in 2018. Yeah, that's not good. That's not good. Man, leverage loan, that's I'm stunned by that. I'm stunned. Now, I don't know if the bulk of that's overseas. I don't know. They say U.S. and Europe. As a business cycle continues to mature and financials conditions gradually tighten, the global economy will be less able to sustain such credit growth. Although many, so figure 1.3 illustrates that credit booms eventually fade, helping to contribute to economic slowdowns. Yeah, that's sugar high. I mean, you're living off debt. You're living off your credit card. You're living life while you are. You're just fancy pants. And then next thing you know, the credit card bill comes in and you got no money to show for it. Or you're just able to pay the interest, but not pay the principal. And then at some point, you default. There's just no other way around that. Or you certainly cut back on spending. 50% of total corporate debt issuance was leveraged loans. Although many emerging market economies are vulnerable, China is a key risk factor given the size of its economy, hefty corporate debt, and rapidly rising household debt. China's debt credit profile stabilized moderately in 2017 and 18 thanks to a recovery in nominal growth and the government's financial deleveraging campaign. So what does deleveraging mean? So it's offloading debt. How do they do that? I don't know, but that's what they do. You deleverage, you have less debt, which is good. Furthermore, a typical emerging market debt crisis that is triggered by withdrawal of foreign funding is unlikely, given that over 90% of China's debt is domestic. So basically, they're saying they're not worried about China not buying bonds. All right, so that's good because 90% of China's own debt is internal to China. The Chinese government has engaged in further monetary stimulus, I bet, is what they're saying, and fiscal easing stimulus. These stimulus measures, alongside strengthened capital controls, will most likely avert a near-term crisis in China and spill over to the global economy. All right. So where should the next recession come from? To understand what factors might cause a global recession today, it is useful to examine what precipitated such downturns in the past. And I like this one here. A more systematic analysis involving a historical sample of 108 recessions in 23 developed nations over the last 60 years shows that the length of the expansion is a necessary but not sufficient condition for recession. So my last video I was talking about how Vanguard seems to imply that we're long. No, that's too strong. is worried that because we're long in the tooth or a graybeard in terms of expansion, that there could be more of a prevalence for in a recession in the shorter term. And my contention was that, well, the expansion has been pretty poor. No other way around it. 2% GDP is not a huge expansion. And Vanguard kind of would confirm that here. The length of the expansion is necessary but not sufficient condition for a recession. Thus, the duration of the recovery provides little insight into the causes, depth, and even timing of the next recession. Right on, Vanguard. That's why I love this Vanguard stuff. Inflation in most developed markets has fallen to more desired levels than since the early 1990s, mainly because of a focus on explicit or implicit inflation targeting by central banks, which is the sources for global or regional downturns have expanded beyond typical inflation pressures. However, there's been no absence of significant inflation shocks to the global economy in the previous 4 decades. The reason behind the dramatic decline in inflation-induced recession since the 80s is that central banks learned to act preemptively in the face of inflation shocks, getting ahead of price-wage inflationary spirals by better managing market expectations. Come on, man. In 2019, we do not see material risk of strong rise in core inflation, despite lower unemployment and higher wage. Okay, I mean, literally, do you really think it's the Feds and the central banks that have been able to put a pigeonhole inflation with their policy structure? No. What was that caused huge? I mean, look at Richard Nixon in the 70s. This is Carter relative to Nixon. I mean, look, at the end of the day, I think Carter gets a bad rap. In some ways he was, don't get me wrong. And Nixon, as a conservative icon, is silly. He had price wage controls. Price wage controls. No conservative should ever even have that word, that idea in that big old mug of theirs. It's insane. And Nixon did it. Price wage controls. Insanity. Carter deregulated transportation business. And I think airlines too. And I think even stock trades, if I'm not mistaken. I think it was Kennedy, of all people, who wanted to deregulate transportation. I don't know what his ulterior motive was, but I think it was Kennedy, of all people. Crazy. Now, if you're a fundamental historian and I'm getting that wrong, I'd love to hear the show notes. But again, going back to my thing, how Barney Frank saved capitalism in the late 2009 and the late 2000s, if I'm not mistaken, it's Kennedy who deregulated over-the-road hauling trucking industry. Is Carter who deregulated airline industry, and was it utility? I can't remember, but deregulated something else too. And then I think stock market trading as well. It was Nixon who put price and wage controls on there. So when you have a government that's putting price and wage controls, the Federal Reserve can only do so much. I mean, my goodness. And so maybe we've learned not that the Federal Reserve has gotten better, but actually the politicians got better, to include Barack Obama, the liberal president we've had since probably FDR, to say, don't do that. You can't do that unless you want incredible inflation. And so the inflationary stuff we saw from the late 70s going to early 80s, going to be attributed to Carter, or it can be attributed to Nixon. Nixon, absolutely. Never mind getting off Bretton Woods. All right. So here's a graph of the recessions that we've seen. So we've seen drivers of recessions, drivers of 108 country-specific recessions since 1960. Inflation, from 1960 to 1989, inflation caused 21 of the 23 recessions, all right? Where only other stuff, external pressures in 1960. So basically from 1961 to 1989, all the recessions that we had were attributed to inflation. Then you go to 1990 to present, essentially from basically 1992 to present, none of the recessions, or two of essentially the recessions, were caused by inflation. Financial imbalance. Financial imbalance. What could have possibly caused that? Financial imbalance. Could that be leveraging of loans? External pressure. I don't even know what that means. But anyways, it's interesting. As you see, inflation is not the driver of recessions anymore. We got commodity prices. We got my daughter just texted me that she's at the Atlanta United parade because the Atlanta United won the MLS Cup for soccer the other day. The first Atlanta victory of a championship since I think the Braves in 1993 or something like that. So people here are pretty stoked. I don't care. But my daughter, she goes to Texas. She's down there. So that's pretty cool. But it's interesting because she has a final exam tonight. What's up with that? And they're texting back and forth. All right. So as you can see, inflation has been taken on the chin when it comes to its inflate and its recessionary component. That's interesting. And then they talk about global risk. And here's where I kind of don't like the Vanguard stuff because they say Vanguard's assessment risk 20% on the negative, 52% on what's that? Goldilocks, Goldilocks, and 21% on positive. So they're basically saying 25 on the left, 25 on the right, 50% down the middle. And so that's okay. That doesn't tell you much. So they're saying there's a 50% chance we're going to stay in a Goldilocks, but there is still a 1/4% chance we could be bad, and there's still a 1/4% chance we could be good. Trade war and protection. I mean, so it's just I don't pay any mind to all this stuff. All right, so let's take a break and we'll go into what they're looking for their stock and their bond outlook as we go into this global growth moderating to trend. These things bore me. Odds was showing a slowdown. At the end of the day, they're saying they think there's more likelihood of recession than there was last year. They're not saying anything that's likely to happen. Of a recession is less than zero. A slowdown is a little bit, certainly slowing down of a growing economy, they're saying has more likelihood than a recession, and certainly more likelihood than growth for sure. But slowing down isn't a recession. And I'm not sure I believe that, but we shall see. I don't think that's stepping on a limb here at all to say we think the markets and the economy will slow down a little bit relative to what it was in 2018. I don't think anyone would say, wow, that's putting on black. It's not like that. So, all right, let's do it part 4, and that will end this up. So don't forget to subscribe and look on for part 4. It's coming up here shortly. Thanks, guys.